Hi, this is Michael Carlin, president of Henry & Horn Wealth Management with your second quarter 2019 Capital Markets Outlook. We are joined today by Joe Tiber of Tiber Kosmala. Joe, thank you again for coming and visiting with us. We really appreciate it.
Pleasure to be here. Thanks for having us, Michael.
Yes. We love having you on Skype, but you know what we really need to do? Since, I have never seen you without a suit on. This is big. You can't see it, but it's amazing. I see Joe without a suit. This is like seeing Santa Claus in his house just in regular pajamas. This is amazing. Although you're wearing a button-down shirt. You look great.
And the thing is, I'm sitting down at a table. I'm actually wearing boxers, and that's it.
Oh, well, and that concludes the market. Okay, so before we get started, Joe, I just wanted to provide everyone with a quick overview about why we do this. And for those of you that know me, you know that I started at Merrill Lynch and I spent a lot of time at Morgan Stanley. And at those firms, they pride themselves on creating this research. And it was back in those days in the mid-90s, it was research had real value. People thought that research meant that you were going to make more money because it was truly exclusive. And today, you kind of fast forward and that research has lost a lot of exclusivity. You can get JP Morgan research or Wells or, again, Merrill Lynch research. And not to downplay any of the great work that the analysts do, because they certainly do try. But there's a big difference between our capital markets outlook and in the research that you're picking up and reading about what the market and the economy are going to do from a lot of those institutions. Those institutions have an incentive to get you to keep your money invested. Don't sell, keep your money in stocks, don't worry about it. And surprising that still to this day that there's still so much optimism usually at the start of a year. And then as the year goes on, the things, the realities start to sink in about what the market and the economy are going to do. The capital markets outlook that we do is data driven. We are intent on figuring out how to position clients in their portfolios. We have nothing to sell. Right, Joe?
Yeah, absolutely. And so sell side, and you being a recovering sell side investment professional, there's the sell side. For those of you who aren't familiar, that's generally referred to as the side of the capital markets industry that is selling equities, or they're selling fixed income securities. They're in the market, or they're in the business of selling securities to investors. The buy side, which is more the side of the capital markets that purchases those securities, right? So the buy side would be, if Henry & Horn has put your money with a mutual fund manager or a separate account manager, those managers are seeking to buy securities, buy fixed income or equity securities. And so the research that they produce is a different spin, right? It's a buy side research angle. And then the third side of the prism, which is why we're in the room, is the independent side. And that's where I think Henry & Horn places, a lot more emphasis in terms of where they look to for guidance. And the independent research is truly just that. It's research that's conducted not because it's selling something, not because it's pointed at purchasing or buying something. It's research for research's sake, truly. So Right. It's research for sale, advice for sale, and that's where we come in with our vendors and work with Michael and the folks at Henry & Horn to provide that angle.
Yeah, we just want to be right. That's it. We want to be right. We want to be independent. So with that, we have to start for this capital market outlook with the Fed. We had an amazing first quarter. We're going to get into some of the results, but it was truly incredible how much the market grew, how much the stock market rebounded from where we were in December and where we closed the end of the year last year. And so I highlighted the 6.2% decline in the S&P 500 when the Fed made the statement on December 19th to December 24th, that little pocket of time. It seems to me that caused Powell to change course because, again, if you remember, go back to September of 2018, Powell was projecting 3 more interest rate increases in 2019. And now, as of the March meeting that we just had, the Fed said they expect no further interest rate increases. Huge impact on the market.
No question. We went from projecting 1.5 hikes in 2019 back in December to now 2.5 cuts for 2019, which is an absolutely stunning pivot, I guess, on the part of the Fed. And as Michael said, we came off the back of the worst quarter that we've seen in over 7 years in the S&P 500, that being the fourth quarter of 2018, and responded with the best quarter that we've seen in nearly 10 years. Really since Q3 of 2019. So a pretty remarkable sort of mirror image. Overwhelmingly would agree, Michael, with your assessment that the Fed was at the apex of that, and their pivot or their finding religion in late December with regard to Fed policy was the catalyst there.
Yeah, and I'm looking at the market, the S&P 500, and you see the second quarter, third quarter 2018 where the market peaked out, and then where it just had exhaustion from the Fed being tone deaf or blind to what the market or the economy needed in the eyes of the stock market, and just the huge and massive decline experienced between that end of that third quarter, getting down to December, I think December 26th or so was the bottom, in this massive surge that we had that ended in the first quarter, and a nice start even to the beginning of this quarter. And if you're looking, we haven't crossed the highs that we experienced in September. So the way that I interpret that as that's a latent negative, and that we want to be making new highs, and the fact that we're not is something to be paying close attention to.
Yeah, for sure. I mean, we're not far below. I think at the close of business last week, I think we're sitting on the S&P 500 about 3% below the September high. So we've clawed back overwhelmingly the majority of that that fourth quarter drawdown. But as you said, I mean, what the Fed narrative in October into November into December. October was their comments on the Fed funds rate was essentially that they felt that they were far below neutral Fed funds rate at the time, back in October. November, the narrative changed to, we're just below neutral. On into December, where they made the death knell by saying that the balance sheet unwind is on cruise control. And that really roiled markets into that first quarter, into the fourth quarter, and sort of got that capitulation. So,
Yeah. And it was a heck of a bear market. I mean, again, the market did drop 20%. So we look kind of historically to say, well, is when you have this bear market rally, it's interesting because we're not again. I think the bear market, when the market drops 20% or more, which we technically did have on an intraday basis, and if you're looking historically, going back to 1929, there have been a number of times where the market's dropped 20%. We've had this kind of a rally. And this one that we experienced in 2018 is from a rally perspective, a heck of a lot more higher and greater than you would see normally. And the duration's a heck of a lot shorter. And I wonder if this has a lot to do with the technology feedback loop or, electronic trading. If this is just a new sign of the times, because if it is, then the days where, as an advisor, I felt like I had some time to make a decision. That window's really seeming to shrink if you look at how quick some of these market moves are.
Yeah, I think there's a lot of things. The decline in the S&P 500 in the fourth quarter didn't meet bear market, technically speaking,
right.
Because I think technically, again, you have to close at a 20%. So an intraday, by all means.
Yeah.
But the pace of it was remarkable. So it was a 3-month period from September 20th to basically December 24th. Looking at major declines in the S&P 500 going all the way back to World War II, the average duration of a major decline in the S&P 500, call it 20% or greater, is about 14 months. And this one was 3.
Right.
And if you look at the dispersion of those, and the average decline depth or loss of a drawdown is 30.7%. So it's usually a little bit deeper and significantly, much deeper. I'll say much deeper and much longer. Right. Both.
And so, and this kind of folds me into the next part of this, and that is one of the things that it seemed to me most obvious is that people are looking for the market rally to end. And one of the key reasons, the easiest reasons, the simplest reasons that people point to is say, well, geez, it's gone on long enough. And if you look at it's a chart that we have, and by the way, you can always email us at info@hh-wm.com. We'll get you a copy of the slides that Joe and I are looking at. And if you look at the end of the expansions chart, is growth done? For me, it lays it out very clearly. And if you look at the longest economic expansions in U.S. history, we're right there with the longest continuous economic expansion in U.S. history in terms of duration, months. But if you look at what's projected for growth moving forward between now and 2020, this would be even longer than we've ever seen by a pretty good margin. So the two things that I notice is that, one, the length of the economic recovery, the real GDP expansion has been huge, and at the same time, the amount of growth that we've experienced in this recovery has been far and away, of all the ones historically that I'm looking at in the chart, the least amount of growth cumulative. What kind of things do you see when you look at this chart?
Yeah, I mean, that's no question about it. The I'll call it tepid growth. The tepid growth of this expansion is evident based on this chart. It's been something that's been written about and studied, frankly, for the past decade, where we've struggled with 2 and change % growth. Coming off of the GFC, the global financial crisis, 2008, 2009, and the debt-laden global economy. If you look back at debt super cycles like that historically, they do typically translate into subdued growth or anemic growth for an extended period of time after that debt bubble bursts. Mm-hmm. So you've got, kind of a work off for the first 5 to 7 years. And then there are all sorts of other things that you look at, globally. You have to look at demographics is a great example. I mean, the declining backdrop of the demographic growth push here in the United States and Japan and Europe, those probably are factoring into tepid growth as well. I like the quote, Michael, that you put up there on the top right of this chart: economic expansions don't die of old age, they get murdered, from Ben Bernanke. And that's something that is 100% the case. And really what he meant by that is he was pointing the finger at himself. Mm-hmm. Typically, it is actually the Fed and a Fed policy mistake that ends expansions. We're on the cusp, mid this year, we're on the cusp of the longest expansion on record. I think that'll technically hit in July of this year. So it's one of those things when we're analyzing markets and economies, stock markets, bond markets, the one thing we really like to focus on is not to get too hung up on economics, but rather look at who's the perpetrator, right? I mean, who's the perpetrator of the downside? You don't look at the victim, which might be a declining ISM first and foremost. You look at the perp, and that perp generally is going to be, the Fed in most cases.
Yeah, and 9 consecutive interest rate increases is a good weapon of choice. So one of the things I wanted to spend a minute on, not too long, because I want to talk about monetary policy influence with respect to growth. And what we've become accustomed to really is a first quarter where you're looking at S&P 500 quarterly performance, and even going back to 1928, it's historically been one of the weaker quarters that we've had to deal with. And it isn't a surprise that we're seeing, and we saw GDP numbers may come in a little bit lighter, and then typically a little bit better in the second quarter. I just wonder, I'm wondering out loud whether or not we're going to see some type of government intervention, some type of additional stimulative force to help continue to push this economic cycle forward. And I wonder, to me, the most obvious would be some type of an infrastructure, railroads, bridges, airports, that kind of thing, to help give us another engine of growth where there's just not a whole lot of expectation and excitement and anticipation over big publicly traded company earnings for 2019. So I wonder, without some kind of a stimulative effect, where are we? Are we going to be lost without one?
So fiscal policy and monetary policy. Monetary
Right.
policy being driven, obviously by the Fed. Fiscal policy and infrastructure spending and budget spending. So, and I just caught this. I don't have the data in front of me, but I did think it was really interesting. And it was a look from, again, one of the independent research groups that we subscribe to. They do really deep fiscal policy analysis. And looking back from the period of 2012 through 2016. The federal government was actually a detractor to growth, meaning there was a decline, a reining in of government spending in that time period. And some of you who might recall your finance classes, it's CIGNX.
Oh,
right?
you're giving formulas out? This is what, oh my gosh, okay.
There you go. Consumer spending, investments, government spending,
Yes.
And then net exports. That equals GDP. It's those factors, really simply. So that fiscal policy component, that government spending component was a detract from GDP for, again, from 2000, I think it was 2012 through 2016 or 13 through 16, to the tune of about 40 basis points off of GDP. Mm-hmm. So about 0.5% per year. That flipped. That switch did flip in 2017 and 2018 both. There was an increase in government spending. As well as a decrease, obviously, in taxes. So the fiscal policy has been a stimulative, but a very benign one. So the push in 17 and 18 was a 17 basis point or 0.17% add to GDP,
right,
as opposed to a 40 basis point detract. Does it go higher from there, as Michael suggested there? Yeah, I think there's push. Frankly, from a political perspective, probably from both sides of the aisle, to fix roads and bridges and get that infrastructure spend done. Beyond that, it's anybody's guess. But right. I do think that fiscal policy likely is going to continue to be supportive as opposed to a detractor like it was for a period dating back in the mid-2012.
Economy, at that time, the economy was just in a better position to handle some of those negative detractors too. But well, we'll have to see. The next two charts kind of rolled up into one that I wanted to point out is that we've got fund flows in decline. So if you look at the largest 20 ETFs and see whether or not people are putting money in or pulling money out, the top 20 tell a nice story about what retail and institutional investors are doing with their money. And if you're looking at the equity side, the stock side of this equation, it's pretty notable that you can even go back to 2017 if you trade a little bit of a longer term trend of this gradual reduction of money being put into the market in those 20 largest ETFs. We saw a little bit of a rebound starting in March of this year. That to me is very telling because can we see follow through where we're going to get interest back in the market? And we're going to talk about IPOs, which I think is a part of the formula to get interest back into the market. But I'm watching that because I am watching the consumer, because at the same time as I'm seeing fund flows for 2018 being pretty neutral, and in the latter part of 2018 into 2019, a lot of fund flows coming out of the market. Yet at the same time, consumer confidence continues to hang in there. So we've got a confident consumers with spending. Wages look good, and there's a lot that goes into consumer confidence, more than just wages and spending. But yet at the same time, we've got the fund flows in decline. You would like to see a confident consumer with a lot of fund flows, money going into the market, but there's just a bit of a disconnect. What do you think? What do you think we're missing, and how do we tie these two things together, Joe?
I guess people are more confident to vote on a survey as opposed to voting with their dollars when
That's
it comes
right.
to investing in this case.
Right.
That's what it certainly looks like. I totally agree. I mean, retail fund flows and how we work that indicator into the matrix here is it's actually a contrarian indicator. So when we see anemic flows in the retail market, that's generally a good thing because you kind of want to move the opposite direction. December, a case in point, I think maybe, Michael, we may have touched on this last call, but that massive panic selling across ETF and mutual fund complexes back in the fourth quarter, which you did not want to do.
Right.
And Henry and Horn's clients did quite the opposite there. They were actually buying at the end of December, moving into both ETFs and funds, equity markets. But retail fund flows being a contrarian indicator, neutral right now, looking very anemic. Institutional monies, which I think we're going to touch on in just a little bit, I think is a little bit different, but yeah, definitely a notable trend here.
See, and that's the thing. See, and you do want to typically work opposite of what everyone is speaking about, particularly when you come to retail investing. But yet at the same time, the Bank of America survey, where they looked at institutional behavior, what was rotated into the most, and this is as of February of 19, pretty fresh data, is cash. Cash being number one, equities generically being the largest area of investing that was the institutions pulling money out of. And yes, there were some exceptions, healthcare and discretionary, two of the better performing areas of the market historically, particularly lately. They got their fair share of money in, but when you're looking at institutions that are adding to cash in a time like February, I'd like to think that smart money knows better. I don't know. I feel like, are they missing the boat?
No question. The behavioral difference between institutional investors and retail investors in most simplistic terms is this. A pension fund, an endowment, or a foundation, the time frame or the time horizon that they're investing for truly is perpetuity, meaning they're investing from where is the market going to be in 2018 versus 2059,
right,
is how they invest. So they tend not to get too moved around by shorter term market movements. I think the one thing I'd comment on that I found really interesting last year with respect to institutional money was the shift from, and this is going to sound wrong because it doesn't sound right if you read the papers, but the shift from passive to active,
right,
actually in 2018. That was pretty remarkable. It was the first time in over 6 years that there's been a money movement from passive to active, and that's so 13%. There was a 13% increase in active equity assets. And passive equity assets across the institutional patch were flat, 0.8%, which is the first time that's happened in quite some time. And I think that might speak to, I think we can get off on that tangent if we want to, Michael, but
fund flows and everything.
Active, I thought, across the institutional investors was a notable one.
Agreed. Well, you're right. We could spend a lot of time on it, but we've got to talk about the inverted yield curve. It finally happened. It finally happened. So I want to make sure I set the table a little bit for those that don't know an inverted yield curve. It means the short part of the yield curve, the 3-month treasury, is actually higher than the 10-year treasury for on the U.S. Treasury market. And so there's a reason why that's critical, is that, some will say, oh my gosh, inverted yield curve, I know that's bad, but why? There's kind of a predictive story that goes with an inverted yield curve. Because if you think about it, no one would buy a 10-year U.S. Treasury, a 10-year obligation, lock their money up for 10 years, when they could buy a U.S. Treasury with a 3-month maturity, and they could be getting more. They could be getting a higher yield. The reason why you would do it is if you're expecting, you would still buy the 10-year if you're expecting the short part of the yield curve to decline. In the short part of the yield curve declines when there's an expectation that the Fed's going to cut rates, which they tend to do when the economy is struggling. So you have this moment where you say, you think a little bit further down the road. You say, well, that's interesting, because I guess we're thinking about the Fed cutting interest rates, which, Joe, you alluded to, and we want to touch more on it, because there's more of a story than banks struggle to make profits when we have an inverted yield curve. We get that. And when the yield curve finally inverted this most recent quarter, for many, it set the clock, which we'll talk about when and if this is and continues to be a signal for a future recession.
Very much. Got a lot of ink, Michael, in terms of the inverted yield curve. A couple of quick talking points on that. There's no question that looking back post-World War II, every single recession was preceded by an inverted yield curve. However, not every inversion was followed by a recession.
Right.
So it does happen without it. There you can get a false signal. This curve, it did invert. It did not invert very deeply. That's the other thing. So you have to look at the depth and how long it stays inverted. And that's one of the things that right now doesn't have us overly concerned. In fact, last week it did come back into positive territory.
Right.
at the end of the week. So, and the depth that there was a Fed paper, it actually dates all the way back to I think it was 97, a Fed paper in 97 that really did some deep analysis on inversions, the depth specifically of the inversion and the likelihood or probability of a recession ensuing. And the depth of this curve inversion, which was less than 20 basis points, translated into about a 10 to 15% chance of recession following in the next 12 months. Had it continued to go deeper, I think our concern would have been, quite a bit more. But I think that it was inverted for a very short amount of time in a very shallow inversion. So it's not something that we, got overly concerned with, at least in our models.
Yeah, and we did have a false alarm in 2006 and 7.
Yeah.
But then it eventually did invert yet again at that time period, which made things a little more challenging. And so the depth being one thing, and there's a lot of information out there that can give us an indication, but it seems like it is an early predictor. In when you have this inverted yield curve, it is a predictor. And again, hopefully this is a shallow one and this is a false signal. But months from inversion to recession is usually 14 months. Now it's all over the board. It can be a little longer, a little later. But even if that signal were legitimate in history being our guide, that would mean sometime mid next year, on average, would be the time where you would expect to see recession numbers start to flow through. Right? I mean, right?
Absolutely.
Okay.
12 to 14 months, I think, is the
Yes.
the general lead time, I guess,
Yes.
post inversion of the 3-month, 10-year. A lot of media outlets will write about the 2-year, 10-year curve, but it's really, as Michael highlighted here, it's really the 3-month,
Right.
10-year that most economists look to. So yeah, the depth and the duration. Generally speaking, you're going to want more than 10 days consecutively, and I think we fell a little bit short, on that front is a part of the reason we're not super concerned. But the other thing that I will mention is this. Right around the same time as actually just before the inversion, you had global bond yields, particularly in Europe, given the economic backdrop in Europe, you had global bond yields really plummet.
Oh, you're going to go there now? We're getting to that one. But we can do it.
Out of order, I apologize.
You're not doing that. It's never out of order. There's no order. But so let's do that. Can we do negative? Let's do negative.
Well, so negative yields in Germany in particular, right?
Yes.
So just as Michael laid out the example of why would you buy a 10-year bond at 2.5% when you can buy a 3-month bond at 2.6%. You wouldn't. Same reason German investors and European investors across the board were faced with negative real yields in Europe. So why buy a negative 10 basis point real yield German Bund as opposed to a positive real return, U.S. Treasury security? So
Right.
there's competing return propositions, for non-U.S. investors that we think, factored pretty largely into what happened on the long end of the curve.
Yeah, and that's the thing, and that when you add it up, over $10 trillion of negative yield worldwide. Negative 10 trillion of negative yield. It's everything from Switzerland, Japan, Germany, Denmark, Sweden, Austria, France, Slovakia. You look down the list and it is amazing that you could buy a 1-year Bulgarian government bond at negative 10 basis points, or you could buy a U.S. Treasury at 255. What would you rather do? So you got to figure that a lot of capital is finding its way to our shores, and maybe the interest rate inversion, due to the fact that there's a real global disconnect going on right now, is the inversion maybe is a little bit less reliable, given the fact that we have some pretty extreme circumstances going on overseas. And as I mentioned a little bit, the Fed does seem to have backed away from further rate hikes. In fact, when I looked at the data, it was a 60% chance of seeing rates drop within the fiscal 2019 year. There's still, about 40% of institutions were looking for rates to remain stable to one more increase. But this is changing dramatically. And I still think that through it all, the Fed's policy still continues to remain accommodative.
No question. I mean, from a Fed funds perspective, and don't forget, they became more accommodative also in terms of the balance sheet. When we use the term, balance sheet unwind, all of the quantitative easing that began back in 2010, so the Fed balance sheet growing from, $500 billion up to $4.6 trillion, and them in the process since early, 2017, in the process of unwinding that $4.6 trillion balance sheet or putting those bonds back out into the market, that's a liquidity extractor. Without question. They've been doing, really for the last 12 months, they've been doing about $50 billion a month, $30 billion of U.S. Treasuries and $20 billion of U.S. mortgage-backed securities. And so with the meeting in in March, they announced that too is going to end prematurely or prior to what they had previously announced. So that is going to be winding up by September of this year. So that liquidity extract, also is going to be coming to an end. So that combined with their forward rate guidance, definitely accommodative, no question.
A couple things. So can we talk about earnings for a second? Can we talk about corporate earnings? So it seems to me that when I'm looking at first quarter projections for publicly traded companies and the number of companies that are issuing negative guidance versus positive, we've got 5 companies issuing negative guidance for every one that is issuing positive guidance. And as a result, it looks like right now quarterly earnings are expected to be negative for the first time since, really 2016. And if you remember, the year ended up well. It took a little bit of time. The year ended up well. So, I take that information into consideration, and also a look that historically, there's kind of always a weird cycle that occurs with expectations for corporate earnings. And I'm just trying to see, is there a historical connection? Should we read a lot into this negative guidance? Get real conservative. What do you think? What do you think we're with related to corporate earnings? What do you think?
Yeah, I think, the negative guidance, I don't know that we should read too much into it other than just knowing that that's part of the game, I guess. And again, you being a recovering sell side,
I know, I can't help it.
Expert professional, you get that, I think, Michael. So the game being corporate management will guide Wall Street down so that they will beat. To the tune of, on average, about 60 or 65% of companies beat their earnings forecast, Wall Street earnings forecast every quarter. That's just on average. So the downward guidance is a wash, rinse, repeat exercise pretty much every quarter. As Michael said, the extent to which earnings were guided down for this Q1 2019 was substantial. So they were cut by about 7.6% was the number that the last number that I had seen. The average downward guidance is more like 2.5% or 3.5%. So close to 2x or over 2x the downward guidance. A lot of things at play here. A Q1 S&P, I guess I think this is an S&P number that the last one I saw is a negative 4.2% earnings growth, which I think is a little further south even than what I think we might have here.
Yeah.
So that's a number that's concerning for sure. The thing you need to have in mind is, what are you jumping over? That's a year-over-year number. So you're jumping over Q1 of 2018, okay? And that's the first quarter that benefited from very dramatic corporate tax cuts. And so your hurdle rate is elevated based on that. So I think you're going to see a lot more this quarter comparison of pre-tax earnings versus pre-tax earnings on a year-over-year basis. Right. And I think that'll give us a better read for really what's happening fundamentally.
Well, and if you're really talking about negative earnings, we got to talk about the IPO market. Because if you want to talk about companies that aren't making money, they're all the companies that we're familiar with. And for a long time, being the sell side, I guess this is the theme of this is going to be me used to being a sell side guy. I used to do all the secondaries and IPOs and everything so I could build the syndicate index so I could get more of the good stuff when it came. And this is the good stuff. Uber, Airbnb, Lyft, Pinterest, which is, next week, you name it. This is a renaissance of sorts where you have all of these privately held companies that for a long time were raising money outside of the stock market and almost seemed resistant to putting their company under the scrutiny of the stock market and quarterly earnings. And on one hand, I saw the research and my jaw dropped, and that is the percentage of companies that are coming out that don't make money it's 81%. And you haven't seen, and the data hasn't seen a number like that until it matches the 81% of of companies coming public that were in the top of the .com bubble burst. Now, granted, huge difference in that there were a lot of companies that went public in 2000. That's not the case today. A lot fewer, but these companies are huge. The valuations are massive, and I have to wonder if a few things will happen. One, will this reinvigorate consumer excitement in the market because they're buying brands that they really use and understand? Two, these are brands that represent, in a lot of ways, the changing landscape of the economy in that, ride share, home share, Pinterest, a different kind of social media, amongst others, where these really are a part of the future way that a lot of business is done and advertised and people are moved and transported. So will this transformative group of companies that are coming in at huge valuations, will it leave enough money to be made for retail and institutional investors for this experiment to work? Or is this a sign of the times like it is in the year 2000? I know. Not to be a disaster. I saw you couldn't see his reaction. It's not to be a disastrous, but I'm just saying it's interesting. To me, it's interesting. What do you think, Joe?
Time will tell. You said it. I mean, time will tell. I always think back to, and you're right. I mean, the rash of IPOs here recently has definitely been, on the radar. It's not something, obviously, we don't look at. We're not stock pickers per se.
Right.
But I will say, managers that we retain on behalf of clients are scrutinizing these IPOs very closely. And I always think back to, obviously the .com bubble, which both Michael and I invested through.
Yeah.
Or Facebook. The Facebook IPO stands out as one that was really greeted by the market with a lot of skepticism, and that's worked out pretty well. So it's really difficult. Different business models, have to be priced very differently, but there's definitely been a rash, and it's been a notable one for sure.
Yeah, and my hope is that this is another leg of investor excitement, in that there's a lot that's shaping up for this market to be and feel a lot like the market of 1998. There was different things going on with Asian currency and things like that, but you did have a Fed cut, you did have the IPO market, and you did have investor enthusiasm. So maybe we see some improvement there. So I wish we had time to do the real estate piece, but we'll have to cover that. And again, should you want to talk about real estate, send us an email at info@hh-wm.com. Happy to take you through it. So let's go to the conclusion. So I have a few notes that I was able to, my friends at Strategas, our friends at Strategas, put together a nice piece on, and they boil down to what we need to do. Few things: keep the U.S.-Mexico border open, get that U.S.-China trade deal done, do not do the EU auto tariffs, got to see some solution with the Brexit. There's a. We got the run up to the Japan value added tax increase. We got a U.S. debt ceiling consideration again coming up, and we got to work to replace the sequester budget cuts. So we've got a lot of things to keep things going, and we've already accomplished quite a bit. We reopened the U.S. government. The Fed did pause. China has done their domestic stimulus, which is great. OPEC has stabilized oil prices, which is good. And we got the guidance on the Fed balance sheet. So we've done a number of things. There's a few things that need to get done that don't feel unattainable, which I hate to be optimistic, but makes me feel like maybe the remainder of 2019 looks pretty decent.
We concur. I think a lot of those things, as you listed those off, a lot of those things are more political, I guess. but also I think I'd agree, attainable. The one thing I'll say and remind everybody on the call is that, when you look at what's happened so far, the S&P 500 is up 15%. When you look at the equity market versus, junk bonds and things of that sort, the equity market feels like it's just near term here. It can't go up like that forever.
Right.
So a pause, a breather. The 65-day rate of change in the S&P 500 right now is in the 99th percentile of observations on the right tail. So some short-term volatility we would expect wholeheartedly.
Right.
It's not necessarily a trading event, but because the Fed seems to be out of the way, and as Michael said, a lot of these more political catalysts out there seem manageable. I'd agree. We're definitely constructive, in and through 2019 for sure.
Yeah, there's plenty to worry about. We just don't have to worry about it right now, right? We can let's worry about that later. So hey, Jamie says we're at the 40-minute mark. We're done. So we're done. Listen, Joe, you were fantastic as always. Really appreciate your time. And when you're nice and close on the microphone, it's like it's hardly echoey. It's terrific. You just get too many windows in your office. It's too fancy. What can I tell you? Thanks again, Joe. This has been our second quarter 2019 Capital Markets Outlook. Thank you so much for tuning in. Thanks again, Joe. Take care and have a great day.
Thanks, everyone.
Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities, member of FINRA and SIPC.